Hello and welcome to ED Insight, where we get you a 360-degree view of the big picture in business and economy. I'm Nikhil Narayan and here's what we have for you on the show today. Two of India's biggest markets, the US and Europe, are in turmoil, but the country's exports are surging. Is something wrong with our export numbers? And an exclusive interview with Swaminathan Ankaleswara Iyer, consulting editor of the Economic Times, on the curious case of India's stellar exports. Our top story first. If one were to go by India's export numbers, there's no crisis in developed markets. India's overall exports from April to September were up a staggering 46%. But not everyone is convinced these numbers are real. Key indicators such as factory output and throughput at ports suggest a very different story. Most of all, the latest numbers that have come in for October may be closer to reality. Exports grew just 11%, the slowest in 2 years. Nikhil Sivadas investigates India's baffling export numbers.
$245 billion or 22% of India's GDP. That's how much exports stand at in the first 9 months of the year. It's not an ordinary feat by any means, especially because the world economy is in the doldrums and India's domestic economy is saddled with rising rates, stubbornly high inflation and low factory output. So how has India achieved this stellar growth?
Trade is increasingly moving from a north-south hemisphere paradigm to a much more of a south-south hemisphere paradigm. And therefore the concentration in India for trade with the Latin American continent, with the African continent, and with Oceania and parts of Southeast Asia. And I think that's where the impetus lies for the future as well. Our growth rates for the last fiscal 10-11 in these geographies have increased by almost about 60 to 120%. And the first 6 months of this fiscal are showing pretty much the same trend.
According to the Ministry of Commerce, last year India's exports in dollar terms to other CIS countries including Russia, Ukraine, Belarus and Armenia grew by 81%. That was followed by South Africa, Latin America and East Africa. Next in line were the Western European countries excluding the EU. That's Turkey, Norway, Switzerland, Liechtenstein and Iceland. South Asian nations like Sri Lanka, Bangladesh and Pakistan, ASEAN, and Northeast Asia comprising China, Korea, Macau, Mongolia, Japan and Hong Kong. And the last two in the top 10 growth markets were West Africa comprising Ghana, Congo, Nigeria and Senegal, and the West Asian and North African countries like the UAE, Bahrain, Saudi Arabia, Kuwait and Jordan.
We closed on March 2011 with a figure of $246.5 million, a growth of more than 25%. And we feel still the export target for this year, which we fixed to $275 billion and government was $300 billion, is achievable.
According to a report by investment bank Jefferies, Asia now accounts for the largest chunk of Indian exports, followed by Europe, US and others. That's not all. It's also a key contributor to export growth, followed by Europe and the US. This changing trade equation and a shift in the product basket has provided India with a winning formula to boost exports despite adverse economic conditions.
What's interesting about the makeup of this export mix is that you're seeing in high-tech areas, including high-tech services and pharmaceuticals, a very, very dominant Indian position in the market. It's unusual to see a situation in which exports of services are more than half those of exports in goods. And that's the case in India.
According to the WTO, last year manufacturers, which include iron and steel, chemicals, machinery, transport equipment, textiles and clothing and other consumer goods, as well as fuel and mining products which include ores and other minerals, fuels and non-ferrous metals, accounted for a majority of India's exports.
Engineering exports have been galloping at 31% at a CAGR year on year. So it's not something that is being cooked up for this year itself, but the last 5 years itself we've been growing at 31%. In 2008-9 when the depression came, we fell from 40 billion to 32.5 billion. And then coming 9-10, we grew to 60 billion. Now if you compare it to the 42 billion, it's an 84% growth. But you compare it to the year prior to that when we were 40 billion, and you compare at 30 odd percent growing every year, we are on track with the growth that we've been doing.
But some think that being on track in a gloomy market may be too good to be true. That's perhaps why India's stellar export growth has come under the scrutiny of several analysts and economists in the past few months. According to a Jefferies report, India's export growth is skewed because 5 product categories having a 40% share in the export basket have contributed to nearly 70% of incremental export growth. These include iron and steel, non-ferrous metals, agro products, transport and electronics. Another 20% has come from petroleum products that have been helped by the downstream effect of high crude prices. But not everyone buys this argument.
On the one hand, you are actually importing, and on the other, you are exporting the same set of commodities. So in that sense, it is the artificial thing. But other than that, if the world commodity prices are increasing and if the Indian commodity prices are not increasing pari passu and it is competitive, that is not unreal. It's a real, it's a real competitiveness, and I don't think that one should really be worried about that part of the export growth.
Sure, one should not worry, but there are those who believe that the growth in exports should have been more broad-based. That's because 45% of the export basket, including gems and jewelry, garments and leather, now contribute to just 12% of incremental growth. So the big question is whether Indian export figures have been driven by commodity prices and not volume growth. The Jefferies analysis states that there's a wide and unprecedented gap between the export surge in India and Indian import data of other countries. For instance, between January and March this year, India's exports to Indonesia, Pakistan, China and South Africa grew by over 100%. But trade data from these countries showed imports to be at sub 40% levels.
There's always a mismatch between our exports and the import data. And the mismatch arises from essentially definitional issues. So the most obvious one is that exports are always reported FOB, whereas imports are CIF, so that if there are any changes in transport or insurance, that will get reflected as a mismatch. But there are other definitional and classification mismatches as well. But as far as I have been able to see from the direction of trade statistics, there isn't any widening of the mismatch.
The Jefferies report claims that any substantial increase in exports should see an increase in shipping volumes as well. However, data analyzed by the firm show that growth in port traffic was at its lowest in a decade, growing at -5% in the past year. Export shipments were growing even slower than import shipments, with growth being flat between March to May 2011. That has led many to believe that exporters may be over-invoicing.
The over-invoicing story is overstated, but I wouldn't rule it out at all. And conventionally, I think our businessmen do use over-invoicing or under-invoicing as a tool to either bring in illegal capital or take out capital.
I don't have any reasons to believe that there is an invoicing problem or that export numbers are extremely high or the criticism in the study says that the government is doing something to the numbers, but I don't take an extreme position where I can say that yes, the numbers are wrong or the numbers are absolutely right.
According to a report by Kotak Securities, increased international scrutiny of unaccounted funds in overseas bank accounts could be forcing individuals to funnel black money into the country. And the export sector would be the best bet to do it. The report alleges that individuals could simply over-invoice exports or even resort to fraudulent exports to bring money in. But the situation on the ground is far more complex.
Well, I think there are concerns about possible transfer pricing as well as problems with possibly getting around various tax laws. We do need to be conscious of this, but I do think it's probably more reflective of just a changing structure of Indians' exports as well as possibly comparing different time periods.
Well, traditionally export and import invoicing, manipulation of invoicing, it has been done
primarily because the exchange rates were unrealistic and because the import duties were very high. Those were the traditional reasons. Those traditional reasons have clearly declined in importance because the exchange rates are effectively market determined, the hawala market has more or less collapsed, import duties are down. However, one can do an exercise matching India's export figures with those of the trading partners. And for example, Global Financial Integrity does something like that and tries to argue that, look, there has been capital flight and that has been disguised through both export and import invoicing manipulations. Now that's a plausible kind of argument, although trying to do something like this, trying to estimate something like this is always somewhat dicey.
So why is it essential to find out if India's exports are real? That's because strong but incorrect export data could mask a slowdown in GDP. For instance, in the March 2011 quarter, 32% of incremental GDP growth was contributed by net exports. If the export figures were not taken into account, GDP growth would have been much lower at just 5.2%. So the debate about knowing the real export numbers is an important one. But even before the data has been studied adequately, there are telltale signs of a possible reversal in trend.
If you look at some of the leading indicators for exports, like new export orders within the manufacturing PMI that we get every month, those have fallen off very sharply, reflecting the fact that the global economy is going through a soft patch and growth in the global economy could be slow in the first quarter of 2012. So I actually believe that export growth at the margin will in fact will moderate over the next few months. And that will add credence to the fact that exports really are being driven by the global cycle and less so by, conspiracy theories at home.
It's clear now that if India wishes to pursue its goal of achieving $500 billion in exports over the next 2 years, it first needs to revamp the existing setup of trade data collection and analysis by government agencies.
Indeed. So how should the government go about revamping the system? And is there a way to ensure that trade data is foolproof? Swaminathan Ankaleswari Iyer answers that and more in just a bit. Stay with us.